Well, hi everybody. I hope you're having a good holiday. I wanted to have a little discussion on the wheel strategy today. I had two personal friends who were trading this strategy, and when I talked to them about it, I found that they were not even aware of the risk profile of this trading method. As an experienced option trader, that was quite alarming. Most option traders, if not all option traders with some experience, will always analyze the risk profile of the option trade. One of the most crucial steps to trading options is you have to be aware of your risk and your reward of the trade that you're taking on. So I want to take a closer look at the risk profile of the wheel strategy today. When you look at this spread, you're going to see that the upside potential of it is very little. What happens is this trade is designed so it caps the maximum profit you can make as the underlying moves up. However, as the underlying moves down, look what happens. It has unlimited risk. In other words, this trade has very little potential on the upside and just enormous risk on the downside. One thing noteworthy about this trade is that the market in general, long term, typically moves up more than it moves down. With this trade design, you're going to actually limit yourself on those bullish moves. It caps the profits. It's very limited. If you compare this trade structure to just buying the underlying, you'll see that the underlying just goes up and up and up, where this one goes up a little and then it goes sideways. So if you're trading this wheel strategy and you're not even looking at the risk profile, well, you're not doing yourself any favors. I do see the initial attraction to this trade, to the newbie option trader, is similar to the way that everyone's attracted to the credit spread or the condor, because people hear that you bring in a credit and you keep all that money. So unfortunately, there's a lot of people out there who just make options seem very simple, in that when you sell something for a credit, you just automatically make that money. But that's not the reality of trading options. Imagine that you buy an underlying, let's say Apple for example, and it moves up 10% or 15% really quickly. Well, the problem is with the strategy, you're limiting yourself. You can't participate in the upside potential of the underlying that you're trading. Maybe you only make 1 or 2%. Then the other problem is, as your underlying crashes, again, let's say Apple drops 20%, well, guess what? You lose just as much as Apple loses. I mean, you could lose 20% of your portfolio. You could lose the whole thing if Apple would just keep going down. So then you have to ask yourself, well, when is really the best time to use this strategy? Well, if you can predict when the market's going to go sideways, then it could be beneficial, because your underlying isn't going to make anything, but this will bring in a little bit of credit. However, since it's impossible to really predict the direction of the market, well, it's hard to know exactly when to use this strategy. So again, most of the time, these markets are drifting up long term. So with this wheel strategy, again, you got to look at the risk profile. You're going to see that you're just limiting the amount you can make in a bullish market. So I hope that you've enjoyed this video. Maybe you learned something that you weren't aware of, and I wish you the best holiday, and I will see you in the next video.